Okay, welcome everyone to our seminar today. Today's seminar, the focus will be on how to choose best business structure for yourself. A brief introduction about myself. My name is Brenda Ferguson. I'm the principal of Impact Taxation and Financial Services. We're an accounting practice based in Bankstown. So I have listed all our contact details here. If after the seminar anyone have any questions, please feel free to contact us. Thank you. Okay, before the seminar start, before we go to the main content, I just want to point out this seminar is for general information only. If you need to make a decision and then you need more detailed information, please make sure you talk to a registered tax agent. Okay, that's the first thing. Second thing I want to mention is we will upload the video to YouTube after we finish. So if you need to speak up during the seminar, please don't reveal any confidential information. Okay, you can also type in your question in the chat box. If you type it in there, then nobody else can see your information. So that might be a safer way. Okay, that's cool. Let's start the seminar. Okay, in Australia, there are four most common business structures: family trust, company, partnership, and sole trader. Okay, they are the most common business structures. There are other less common structures. Some of them are quite similar to one of these ones. If you have any other questions on different types of business structures, if they're not listed here or covered in the seminar, please let me know, and then I can give you a separate private session. So other structures like business trust, like unit trust, or superannuation. Okay, we will have future seminars that focus on superannuation, but it's not covered in this seminar. All right, okay, now let's go to the main part. So before we make a decision on what business structure to choose, probably there are two main considerations. One is tax purpose. So which structure is the best for me so that I can save tax? Okay, that's the first considerations. Second main consideration is asset protection. Okay, but in this slide, we'll have a look the tax consequences first. Okay, so for sole traders will be taxed on the individual's marginal tax rate. So let's say if a sole trader business, the person might have other employment income. So the sole trader income will be added on top of his other income to pay a marginal tax rate. Okay, that's for sole traders. For partnerships, it's quite similar to sole traders. The only difference is different partners will receive separate distribution from the partnership income. Okay, and then on that distribution, they have to add it to their other income to pay marginal tax rate when they do their own individual return. Okay, for a company has a flat rate. Okay, for very big companies, the flat rate is 30%. Okay, for smaller businesses under 50 million sales turnover is 27.5% at the moment. It's going to be reduced to 25% in a couple of years' time. Okay, so that's for company. For family trust income can be distributed to different family members to reduce tax. So let's say, for example, if you generate maybe 100K from a family trust, potentially you can spread it to 6 family members, then everyone's income will be below the tax-free threshold, then you don't need to pay any tax at all. Okay, so that's one of the main advantages of a family trust, and we'll cover it in more detail later. Okay, so that's the tax side on business structures. tax considerations. So next main consideration will be on asset protection. This is very important because tax is not the only consideration. Asset protection is very important. And sometimes when people make a mistake and they know, they understand, it's already too late. So please pay attention to this part. Okay. For sole trader, there is no separation between business and private assets. So what does it mean? It means for a sole trader business owner, the business is himself. So if he did something wrong in the sole trader business and someone was to sue him, that person can actually tap in the sole trader's personal asset, his private property, his house, his car, to claim a business liability. So it's quite risky from that side, okay? And then for partnership, it's even riskier than a sole trader. Okay, so partnership, first of all, is not a separate legal entity as well. And there's no separation between business and private assets. Okay, so similar to sole traders, if people were to sue a partner in a partnership for a business liability, they can tap into the personal asset. And then to make it worse, the partners are separately and jointly responsible for business liabilities. So let's say, for an example, if one partner, say there are like three different partners in a partnership, one partner might have incurred a business liability with a third party. Okay, then the partner either pass away or escape the country, then the other two partners will be left liable to pay this debt back. Okay, this even happens if they even had no knowledge of the initial business liability. Even they didn't know about it, they are still liable. Okay, and then their personal assets are still can potentially be impacted. Okay, so this could be very risky for partnerships. Okay, and then next one is company. Okay, a company is a separate legal entity. So one is a separate legal entity. It will give you a very good protection. That means you have a separation between business assets and personal assets. So if someone was to sue a company, then basically, generally speaking, the liability is stopped against the company asset. Okay, it's actually stopped there. So it can't tap into the owner's or director's personal assets. Okay, on some very rare occasions, so I put a note there. Sometimes directors can be personally liable. So on what type of occasions? Okay, if the company is insolvent, the directors are still trading. Okay, it's actually can't pay back his own debts, and then they're still purchasing goods or services from third parties. Then in that situation, the directors are liable, personally liable. Okay, or sometimes if they have employees, they have PAYG liabilities for salaries. Okay, PAYG means the tax, withholding tax, they need to pay to tax office on behalf of their employees. Also, their super guarantee liabilities for the employees. You know, in Australia, you need to pay 9.5% of the super guarantee for your employees to their super accounts. If you don't do that, and then that could be a part of the director's personal liability. Okay, recently because of COVID-19, there are some changes temporarily only for the COVID-19 period, you know, for bankruptcy laws or for directors' responsibilities. If you need more details on that, please let me know after the seminar. Okay. Okay. Next structure, business structure, family trust. Family trust, they are not separate legal entity as well, but they still have separation of assets. The reason being, the beneficiaries, they don't have direct ownership of a family trust. Maybe I should give you a brief understanding of what is a family trust. So it's a little bit complicated for people if you never had experience about family trust before. But I guess the underlying concept, there are a few, maybe three most important concepts underneath a family trust. The first one is a trust entity, so trust itself. Okay, so basically it's the structure you are putting your asset or your business in. Okay, trust entity. Then the trustee is a manager of the trust entity or the trust assets. Okay, trustee is a manager. All right. Then there are beneficiaries. So beneficiaries are the people who are receiving distributed income from the family trust. Okay, so to remember the three concepts, then it's going to help you to better understand our future slides as well. So there are no separation of, it's not a separate legal entity, but there is separation of assets because when you put assets inside the trust, no beneficiary have ownership for it. So the trustees are managing the asset and beneficiaries have no ownership. So that means that's the reason why there's no separation of assets. Okay. Trustee could be responsible for trust debts. That's the reason why we normally would recommend a client, if for anyone who wants to set up a family trust, we normally ask them, do you want to set up a corporate trustee? So a corporate trustee is a company, okay, it's actually a company structure that's put in there to act as a trustee of a family trust. So instead of just a natural person, an individual, we put a company structure as a trustee, basically the manager of the family trust. So the benefit of it is when the trustee could be responsible for trust debts if there's no asset in the company. Remember also company is a separate legal entity. So if there's no asset in it, then it's actually providing perfect protection, okay, for the separation of asset. Because for anyone who's suing a family trust, when they trace back to the trustee, to the corporate trustee, there's no asset in there, then there's nowhere to go. All right, so that's generally the case. Of course, recently there are cases, especially for in the family course, if husband and wife have a divorce, there were recent cases that's occasionally overruling this fact. But if you're interested, let me know. But generally speaking, family trust is also a very good structure to protect your personal asset. Okay. So now let's have a look at next slide. So the next 4 slides, we are going to provide more details on every single structure so that you have a better understanding about it. The first one we're going to have a look at is a sole trader business. Okay, so what's the benefit? What's the advantages of a sole trader business structure? It's very easy to set up. Okay, you can even register yourself an ABR website, very easy. If you pay an accountant to do it, it's not expensive, okay? Probably around $100, you can have ABN registered. And then also there will be less ongoing charges, accounting fees, tax return, because it's very easy to do for an accountant. So the related charges are very low. Okay, the structure is very simple, very easy to understand. Because once you calculate business income, you just add it to other income and then calculate tax. It's very easy. Okay. Then is also the capital gain tax discount. So when I put a CGT there, that means capital gains tax. Okay, there's a discount on capital gains tax of 50% for investment that's held above 12 months. So very commonly, people, if they have shares, if they purchased investment property, so as a sole trader, if they hold the shares or the investment properties more than 12 months, they have a 50% discount on the capital gains tax. Okay, and then the business loss potentially can be used to offset other income. So sometimes if they if people have a sole trader business, they might incur a big loss in the sole trader business. But at the same time, they might have other income such as employment income or rental income from their rental properties. So potentially they can use their business loss in the sole trader business to reduce other income, to reduce their overall tax. But there are underlying regulations, non-commercial loss rules. Okay, for anyone, if you're interested, let me know, and then after the seminar, I'll help you. Okay, for sole trader business, the disadvantages are very risky. So the first one is very risky, as what we mentioned earlier, because it's not a separate legal entity, and there's no separation between personal asset and business asset. Okay, so very risky. Also, it's taxed on the marginal tax rate for an individual taxpayer. That means a lot of tax you have to pay if you are a high income earner. But for other possible structures, potentially you can use income splitting to get other people, family members or other people, to come in to help you to share the load of the tax. The sole trader, you don't have that advantage. Okay. Also, on the tax saving side, there's less flexibility with tax saving as well. So some other structures, when we talk about companies, because it's a separate legal entity, so you can basically treat yourself, okay, as a shareholder, director. You know, it happens quite often. You are the owner, you're also the director of your own company once you set it up. If it's a company structure, as a director of the company, you can treat yourself as an employee of the company. Then there are the allowance you can pay yourself as employee. You know, there are potentially FBT, you know, a fringe benefit tax savings. Okay, then we'll mention a little bit later. So, so there will be less tax planning opportunities if you are running a sole trader business. Okay, so that's on the sole trader business. Okay, partnerships. The pros, advantages of it is also is relatively easy to set up. So basically, different partners can just get together. They can either have a partnership agreement, or it's not a legal requirement to even have a partnership agreement. So they can just get together and then form a partnership by themselves. Okay, it's really easy to set up. Then they can split income with each other. So when there are different partners, they can basically split the partnership income to different people. They also have the capital gains tax discount of 50% if they have investment, if they're holding the investment for more than 12 months. Okay, then also for business loss, potentially they can use it to offset other income as well. So similar to the sole trader business. Okay, the disadvantages is very risky, as what we mentioned before, because partners are separately and jointly responsible for each other's business liabilities, even if they has no knowledge. Okay, if even someone has no knowledge what other partners did, incurred business debts, they are personally liable as well. Okay. Also, it's very complex with a succession plan. So every time when a partner want to join a partnership or a partner leave the entity, is very complicated. Okay, so it's almost like the business is stopped and then sold to the new partners altogether. There will be capital gains tax issues, so it's very complicated. All right, so that's the disadvantages of partnership structure. Okay, with a company, the advantages, the first one is better asset protection. It's very important. Okay, it's much safer than sole traders or partnerships because you have a separation between personal asset and business asset. Okay, on the tax side, you have a flat company tax rate. Okay, that tax rate is 27.5% for a small entity, going to be reduced to 25% in a couple of years' time. In 2021, this current tax year is 26%. Okay, so there's a flat company tax rate. Also, of course, you can potentially have income splitting. You can split income from a company as well. So you can potentially pay, if a family member is working with you, you can pay salary. And then, or if you have different family members drawn in to set up the business as shareholders, that you can split the dividend income between different family members as well. Okay, and then we briefly mentioned before, because it's a separate entity, so the directors can basically treat themselves as an employee. Then they can pay themselves travel allowance, potentially meal allowance, then FBT minor benefit with exemptions, okay, things like that. Okay, and then also with a company, one is very flexible. You can choose to leave profit inside the company and pay out later. So how do you do it? So for example, it's happened quite often. Shareholder directors, they are the same person. Okay, then basically the company or the director decide to pay himself a certain level of salary. So by paying more salary to himself, he's reducing the company profit. Okay, by paying him less salary, then the company profit will increase. Also, if you have a family member working with you, and then depending on the hours, so you can give that person a pay rise, like hourly pay rise, to pay the family member a little bit more. Then basically by shifting between your own salary and the company profit, so you are changing your tax around, so you have that flexibility, and then you can leave the profit in the company, basically just pay that flat rate. Okay, pay the company flat rate, and then you can get the dividend out in the future years. So it happens quite often sometimes, especially if, let's say for an example, you have a good income from your company, then you can still choose to pay yourself a small salary this year, say 37K. Then you pay tax on the individual tax. The remainder of it, you pay the company rate. Then maybe next year you want to take the year off, just go travel around. Okay, then that year you can pay yourself another 20K, and then you don't need to pay any tax on it. Okay, so basically you can leave the profit in the company, and then you can slowly get it out. Or if it's a bad year, you don't have a lot of other income outside the business structure, then you can choose that year to pay to get more payment out from the company. Okay, so dividend payout. Okay, so that's one of the flexibilities of a company. Okay, then the succession of company ownership is very easy to transfer. Okay, you can basically just sell company shares. So company shares, say for example, if initially you set up as 100 shares and $1 each, you invest $100, the later years, you can basically use that 100 shares, split it. So maybe 2 other people want to join in your business. You can give one person 20% share, the other person say 10%, and then basically sell them as shares to them, basically passing a part of the business to other people. Okay, so it's very easy to transfer a part or all of your business. Okay, and then also the last one advantage is mainly comparing to a family trust. So family trust will mention a little bit later. It's very hard to get someone as a part of the owners in a family trust. Okay, but if you have a company structure, it's easier to get unrelated parties to join in the business because you can just sell shares to them. Okay, with a family trust, it's very hard to do that, to get an unrelated party involved in the business. Okay, disadvantages of a company is more expensive to set up and maintain. Okay, because the underlying accounting procedures will be more complicated, because with a company there have to be financial reports done, the tax return form is different, so it's quite expensive. Okay, initially with a company you have to register with ASIC. You need an ACN number to start with, and then itself will cost around $500. That's paid to ASIC, and then every year you pay about I think $270 a year to ASIC as the admin fee. Okay, because they are the supervising organization from the government. Okay, so you pay that annual fee to ASIC. Okay. And then also, as we mentioned earlier, in some occasions, directors are personally liable for debt, for business debts. Okay, we mentioned earlier already on the insolvent trading or employee super or PAYG salary withholding, with the debts related to those items. Okay. Also, for directors, also owners, if they pay themselves a salary, they need to pay super. Okay, if they pay themselves, so in New South Wales, if they pay themselves more than $7,500, they also need to purchase workers' comp insurance. Okay, a lot of people don't know about this. So make sure if you pay yourself a salary, if you're a company director, you pay yourself a salary, you have to pay super for yourself. If the annual salary is above $7,500, you need to pay workers' comp insurance as well. Okay, and also another very big disadvantage of a company structure, if you put any investment in the company structure, such as shares or investment properties, even if you hold the investment for more than 12 months, you don't have the 50% capital gain tax discount. Okay, we mentioned earlier, some entities have the discount. Okay, sole traders, partnerships, family trust, they all have the discount. Company don't have it. Okay, so that's one of the major disadvantage for a company structure. All right, family trust advantages, better asset protection. We mentioned earlier, especially if when you set up with a corporate trustee that has no asset in it, because when you incur if someone was to sue the entity, they can only trace to the trustee. Okay, when they go to the trustee to claim their asset, if there's no asset there, then that's a stop there. Okay, so a family trust with corporate trustee that has no asset in it will provide extra protection for a family trust structure. Okay, and then for a family trust, it's very popular with in Australia for family businesses, because basically the owners can split income among the family members to help them to reduce tax. Okay, That's one of the main advantages. Also, of course, you can also use the employee allowance, because basically, especially if you have directors for corporate trustees, then they can be treated as entity, as employees of the family trust as well. Okay, you can claim the allowance or pay any employee working in the family trust an allowance, such as travel allowance, meal allowance. Okay, and then also there's something called streaming. Okay, family trust streaming. You can actually still have that 50% capital gains discount. Not only that, you can elect to choose the family members who had a capital gain loss before. Okay, so you can choose those people to give them capital gains tax income. So if there's a gain, okay, you can give them that gain first because they had a capital loss before. The capital loss before will help them to reduce their gain now, then they pay tax on the remainder of it. Or sometimes maybe they don't need to pay tax. Okay, so that's the streaming. So similar to capital gains tax and also franking dividend that can be allocated to some of the beneficiaries. Doesn't have to be all of them. Okay, can be streamed to certain number of beneficiaries. Okay, family trust is quite popular to be used to protect vulnerable family members. Okay, because with a family trust, the beneficiaries can't tap in, they can't really claim ownership of the asset underneath family trust. Okay, so say for an example, if a family member has an issue like addiction with alcohol or drugs, then the parents might have a lot of asset, but just so that to prevent that person to claim any ownership of the asset, they can put their asset or their business inside a family trust. Then they can distribute some income regularly to this person so that that person will not lose income, but also he can't claim any ownership of the underlying asset in the family trust. Okay, so so family trust can be used to protect those family members so that they can still have income, but they don't blow it out. Okay. Okay, I put a couple notes there. To make sure you pay attention to corporate trustee. Okay, if you set up family trust, make sure you set up a corporate trustee to give you that extra layer of protection. Okay, and then family courts, because of a case happened, I think it was a couple years before, a few years back now. It's basically possible now, occasionally in a family, like a marriage breakdown situation, potentially trust asset can still be reached, okay, in a divorce situation. So just so that you know, potentially, even though it is a perfect protection with structure for asset, but potentially there's still other possibilities. Okay, the disadvantages of a family trust is quite expensive to set up, because setting up a family trust will involve a trust deed. So trust deed is basically the document related that's governing how to run a family trust. Okay, so the trust deed is a very long document, and you also need to pay stamp duty to get it stamped. And then if you want to set up a corporate trustee, you have to pay ASIC, that registration fee as well, around $500. So it's quite complicated, more expensive to set up. To maintain a family trust is quite complicated too. So it's quite a specialty for an accountant to understand or know the related tax knowledge to be able to help you how to best utilize the structure to help you to save tax. Okay, so there are other knowledge, tax knowledge, and then also the tax return itself is more complicated, different items on the tax return form. So it can be quite expensive, okay, to set up and maintain. And then the tax loss inside of family trust can't be distributed to family members. So remember we mentioned earlier with the sole trader business or partnerships, if there are losses within the entities, you can potentially provide it if it's meeting the non-commercial loss rules. You can use the business loss to reduce other income to reduce your overall tax. With a family trust, you can't do that. So you can't really utilize tax loss. Okay, actually it's similar to a company structure. With a company, the loss is also trapped there because it's a separate legal entity. Okay, so tax loss, you can't distribute it to family members or to beneficiaries. Okay, and then also with the family trust, all profit every year you have to distribute to family members. So if you choose to leave the profit inside the family trust, is charged the top marginal tax rate. So it's very expensive to a lot of tax to pay. Okay, so you have to distribute all your profit from the family trust to beneficiaries. So that's a major difference. One of the major differences between family trust and company. Remember we mentioned in our last slide, with a company, you can choose to leave the profit. So you pay the company tax and leave the profit inside the company. Okay. And then you basically just pay a flat rate, company rate. With a family trust, if you want to do that, you pay the top marginal tax rate. Okay. And then also, if you have minors in the among the beneficiaries, so minors are children below 18 years old, maximum tax-free threshold you can pay to them is $416 per year. Okay, on top of that, if you want to pay more, between 416 to 1,000, I think it was $1,037, somewhere around there, is taxed on 66%. Then above that, top marginal tax rate. All right, so it's quite hard to distribute to minors, but once they turn 18, you can treat them as an adult. Okay, then pay them as an adult taxpayer. Okay, and then also with family trust, there's no clear ownership. Okay, and then as what we mentioned earlier, it's very hard to get other people, unrelated people, involved in the business. All right, so that's what we mentioned earlier, the advantage of company, because company can just sell shares to unrelated people, okay, then to get them to become a part of owners of a company. But with family trust, it's very hard, okay. And then also sometimes there can be family disputes, and then running family trust could be quite difficult. Yeah, during the time. Sometimes a family might have different people nominated as the trustees or as directors of a corporate trustee. Then if there are family issues, it's very hard, you know, with how do you distribute income, and that could cause some issues. Okay, so that's on family trust. Okay, now it's the question time. Does anyone have any questions?
Oh, so with the tax loss, you said it can't be distributed and it's similar to a company. What do you mean by that? Like, so if I make a loss this year, I can't offset it with a profit next year. That's the same with company and trust?
So basically, so with a sole trader business, you know, if you have other income, potentially you can use it to reduce it. But with a company, say if you incur a company loss, say 20K this year, you can only postpone it to next year to offset your future income inside the company. You can't really take it out. So as an individual, you might be the owner and the director of a company. But the company loss, once it's there, let's say to give you an example, say you're the owner and director of your own company. At the same time, you work as an employee for someone else. Then you earned, say, 30K income. Then in the company, you might have 20K loss. So if that company structure, if the 20K loss is actually incurred in a sole trader business, if it's meeting the non-commercial loss rules, you can actually use that 20K to offset your other income, employment income of 30K. Then basically your net income at the end will be 10K. Then you're not paying any tax. Does that make sense?
Oh yeah, yeah.
But if you were a company director, and then you have a company loss of 20K, that company loss, you can only use it to offset future company income. You can't really get it out to offset that 30K employment income you received from someone else. Does that make sense?
Yeah.
Yeah. So basically that means it's actually you have to state that loss is actually trapped inside the company structure. So you can use it to offset future income.
In the company.
In the company.
Okay.
Yeah. Does that make sense?
Yeah. So if I make a 20K loss now and I make a 50K income in that company next year, then overall net is 30.
That's right. So next year, you only need to pay company tax on the 30K.
Oh, I see. Yeah.
Yeah. Yeah. That's how it works.
Oh, okay.
Okay. Does that make sense?
Yeah. And that's the same with the trust as well.
That's right. Yeah. So with the trust, so on the plus side, one is having a profit. It has to distribute every last dollar to the beneficiaries. If it doesn't, it's paying the top marginal tax rate inside the family trust structure. And then on the downside, so when it's a minus, like a loss, then the loss can't be distributed in a family trust. It also have to be postponed or deferred to the following years until the family trust has a profit.
Oh, I
Does
see.
that make sense? And
Yeah.
then the profit will minus so we'll utilize the loss first, then pay tax, or distribute the remainder of it to beneficiaries to pay tax. Does that answer your question?
Distribute it to the remaining beneficiaries. They have to pay tax on it.
That's right. Yeah. So the loss, let's say an example on family trust. If you have, say, 20K loss inside the family trust, then that 20K is trapped inside the family trust as well. Then let's say next year you have a 50K profit inside the family trust, but that profit will be reduced by the initial loss of that 30K.
Yeah.
Does that make sense?
Yeah.
So the remainder of, what did we mention? 20K loss, right? 20K loss. Okay. So 20K loss year one, 50K gain profit year two. So the 50K will be reduced by 20K. So the net profit will be 30K in year two. So the taxable profit. Then that profit can't stay inside the trust. So the 30K have to be distributed. You have to distribute that 30K to different beneficiaries.
Oh, yeah.
You can give 10K to the first beneficiary, 20K to the second one, but you can't leave any profit inside the trust.
Oh, yeah. Yeah, I got it. Yeah.
Does that make sense?
Yeah.
Okay, perfect. Thank you for the questions.
Oh, no worries.
Yeah, perfect. Any other questions?
No, no.
No? Okay. I don't think anyone else will have any questions. So let's continue to the next slide, next section.
Okay.
Okay, thank you. Okay, let's go to the next section. Okay, so there are because there are limits for all the different structures. So sometimes people actually link different structures with each other to basically use their strengths together, so make it stronger, so make the whole structure stronger. Okay, so the first example I put here, of course, it can be more complicated than this, but this is just an example. Of course, at the beginning, I need to mention for a more complicated business structure, make sure you always have professional advice. And also, unless absolutely you have to do it, don't do it, because one is more complicated. There will be more expenses for you, you know, registration fees, accounting charges, tax return. So the fees will be quite expensive. And then another thing is, it's going to be very hard to understand. So when there are compliance issues, is very complicated. So if you don't think you are very good with you know, tax knowledge, or easy or you tend to understand, maybe try to avoid, or if you don't know, a very good professional to help you. Okay, just want to mention that. So the first, but after saying that, so some situations, they are actually very good to help you to provide more asset protection, also tax savings. Okay, the first example I put there is a combination of family trust and company. Okay, so family trust is on the top. So basically, you set up a family trust structure first. Then you have different beneficiaries. So beneficiaries as individuals, and then you can set up a company beneficiary. Okay, then you can allocate a part of family trust income to the company beneficiary. So we give it a special term, we call it bucket company. So why bucket company? It's a little bit like you can put some water there, so save some water in the bucket, save it for future. Okay, so what are the advantages of a structure like this one? So with a family trust, we mentioned earlier before, you can give, or basically, of course, on the asset protection side, it gives you a very good protection of the asset. And then when you allocate any profit to that bucket company, that anything left there, the bucket company will protect it as well, because it's separate legal entity. So of course, an extra layer of asset protection. Okay, then on the tax side, family trust, you can distribute income to different family members to help you to save tax. Okay, and then remember we mentioned before, you have to distribute every single dollar of the profit out to beneficiaries. If you don't, you pay the top marginal tax rate inside the family trust structure. But if you add a company as a beneficiary, you can choose to transfer a part of the profit or distribute a part of the profit to that company. Okay, and then under the company, the flat tax rate will be paid. Okay, here there's something with this company, because it's not a real operating entity. So for an investment company only receiving passive income, the tax rate is 30%. But even if it's 30%, it's still better than the top marginal tax as an individual. All right, so that's quite important, because that the top marginal tax rate is 47% at the moment. It's actually quite high. When you compare 47% to the 30%, is still a big tax saving. All right, so I put a note there on the left on division 7A rules. So what it is basically the underneath theory is a little bit complicated, but basically in this scenario, when you distribute a profit from the family trust to the bucket company, you have to physically transfer the money out. Okay, that's important, because sometimes inside the family trust, there might be an operating business. So some people might use family trust to run a real family business. Sometimes they prefer to have the money left inside the family trust to pay for business expenses. Okay, for normal beneficiaries, because they have that you know, overdraw facilities. And then, but with a bucket company, once they transfer the money, if they have to transfer the money out, they can't leave the money inside the family trust. If they do, there will be issues on Division 7A. So potentially there are different regulations. So potentially, if they break the rules, they might need to pay interest. So regulated by tax office. So an interest payment might incur. Okay, because they might have to convert that balance as a loan. So if they don't pay it out, so they potentially will have to pay an interest. Okay, will incur interest expense. So that's on this structure. And then just as one of the examples, next example I want to mention is also a combination between the two structures, but this time you put the company structure on the top. So you set up a company first, then the underneath shareholders or the ownership will be individuals and potentially a shareholder as a family trust. So then when you want to pay out dividend, okay, you can distribute a part of the dividend to the family trust. And then from there, the dividend income can be distributed to family members. So that's like a combination of the two structures. So of course, it can, because there are two layers and then potentially more asset protection. Okay, then another layer or for the tax saving side, you can utilize both of their strengths. So with a company, you can choose, sometimes if you want to, you can leave more profit in there, okay? Or you can choose to pay the dividend out. When you pay the dividend out, you can allocate a part of it, depending on the ownership percentage. You can give out a part of it to a family trust shareholder, and from there it can be paid out to different family members. So that's another possible structure. So with any time when is involved a company, so remember we mentioned earlier with the investment asset, if it's inside a company, you don't have the capital gains tax discount, you know, that 50% normally an individual or a sole trader will have. Inside the company, you don't have it. So that's so just need to make sure you understand if you want to purchase anything investment in the company structure, okay? And then also if the investment is inside a company, there's no streaming for capital gain or franking credit, as we mentioned before, that you can use a family trust to utilize. Okay, so that's the second example I want to give you as a combination of different structures or potential combination. And then even though I only give you two examples here, but you can probably consider other even more complicated structures. So let's say, for an example, for partnership, you can potentially use companies. Say if two people want to form a partnership, then they can each set up a separate company by themselves. Then they put themselves as directors for those companies. Then they use a company structure to join together as partnerships. Then that's going to be much safer than joining in a partnership as individuals. So because remember I mentioned earlier, partnerships are very risky, okay? And then, but if you join in as another entity, you know, as a company or a family trust, so the protection will be there. So even on the top layer, okay, the partnerships are quite risky, but if a third party want to trace back to the business debt, like come back to the sue the entity for business debts, they go to the first level, okay, and then when they go to the partnership, separate partnerships, the partnership with separate entities, then those entities features or their functions will come into the play. Okay, then stop basically use their own protection there to protect the underlying assets. Okay, hope that makes sense to you. Okay, so that's different structures. Okay, actually, I just want to mention, because I think it's quite a complicated topic, does anyone have any questions on this? Just like combination of different structures. If no question, then we'll just continue to PSI income. Okay, so PSI income stands as personal services income. Okay, so what is personal services income? It's basically derived from someone's personal exertion. So for your own labor, skills, or expertise. So let's say I work as an accountant. That's an example. So also more than 50% of the income is actually coming from those activities. Okay, an example using myself, I am an accountant. So am I providing PSI services? Do I earn PSI income? Of course, the answer is yes. Okay, because I'm using my own labor skills or expertise to earn my income. All right, so I definitely earn PSI income. All right, so then once you decide, okay, you earn PSI income, you need to have a look at the test. Okay, the test being, actually one thing I should have mentioned at the beginning for this slide is once you earn PSI income and it's not a PSI business, then there's no income splitting. So, you know, we mentioned a few different ways earlier on the tax side, how to split income with other family members to help you to save tax. But if you earn PSI income and you're not running a personal service business, then you can't utilize that function, okay, no matter what business structure you're running. So either company structure or family trust. So that's the reason why it's important to understand what is PSI income. All right. Okay. So the first step is you need to look at, do I earn PSI income? Then you need to have a look at the test. Okay. The first test is results test. So once you decided you earn PSI income, then for at least 75% of the personal services income, you need to have a look, is payment made to produce a specific result, okay? Then using myself as an example, as an accountant, when I receive payment, is that made to produce a specific result? The answer is yes, of course, because we are providing the services, we're doing the tax returns. So basically the result is financial reports, okay, tax return paper. We're also lodging the tax returns. So there is a specific result related to every payment we receive or I receive, okay? The second question, do you provide your own equipment and tools? Okay, equipment tools. Again, using myself as example, I use my computers. Okay, I got my own office furniture. I actually have a separate office, but that's something else. But I do provide equipment and tools to be able to provide the service. Okay, so that answer is yes again. And then, okay, the third one, and the results test, mistakes must be rectified at the expense of the service provider. So I'm the service provider. If I make a mistake on any tax returns or any financial statements, do I have to rectify at my own expense of the mistakes? The answer is yes, of course, I have to. Okay, so that means as an accountant, I'm passing the results test. So that means I am running a personal service business. Okay, so once that's decided, okay, I can basically choose any structure, okay, company structure, family trust, to run my business, run my accounting practice, okay, because I passed the results test. So what if you can't pass it? So there are other rules, okay? Let's say you can't pass it, then you need to have a look at the second test. It's an 80% rule test. So basically, under this test, you need to make sure that your PSI income comes from quite a few different clients. Okay, not just from main source, like if 80% of your income come from the same client, from the same source, okay, then you're not passing this test. Okay, so if you have quite a few different clients, you need to have a look. Is any of them making up more than 80% of your income? Okay, if it does, then you can't pass this test. But if you do, then you pass this test. Okay, if you can't pass this test again, then you need to go to the next test, remaining tests. So what are they? First one is unrelated clients test. So your services have to be offered to the general public. So basically, you can't be working for one company, basically, okay, or mainly for one company, and then or a related family member, and then you're saying is actually personal service income. You can't do that. You have to be offered to general public. So of course, I passed the test already earlier as an accountant, but using ourselves as an example again. So we offer our accounting services to the general public. So that means we can definitely pass this test. Okay. Then also unemployment test. So employment test. So that means you are actually employing other people or contract other people to help you to complete at least 20% of the principal work. So using an accountant as an example again, if I am employing other people or get a third-party contractor in, another accountant, and I actually pay that person more than 20% of the principal work, or accounting services, then I'm passing this test. Okay, so that's employment test. Business premises test. Okay, that's the third test on the one of the remaining tests. So basically, you need to have a location, like an office. And that office or that location need to be mainly for personal services work. Okay, so when you mention mainly, have to be most of the time or more than 50% of the time, or mainly for personal service work. Also, that place have to be used exclusively by the taxpayer. So say for example, if you share office with someone else, maybe there are a lot of business rental places. Sometimes they give you an office and you can go there, just use that office for one morning to hold a meeting. Then that location or the office is not used exclusively by the taxpayer. Okay, because you're sharing it with someone else. Okay, and then that place have to be physically separate from the home. So if you have a separate room inside your home, and you're saying, okay, this can I just say that room is my home office, and then can I meet that test? The answer is no. Okay, so you have to be physically separate from the home. Okay, separate from your house. Okay, it also need to be separate from the clients or other associates. So typical example, if you can't pass other tests before, in reality, you might just have one employer actually in reality, okay? Then you actually go to that person's office to work and you claim that entity or that company is actually a client. And then you go to their office to work. Then that means you can't pass this test. Okay, so that's personal services income. So you need to make sure you can pass the test first before you decide, okay, I want to choose a certain business structure. Because if you can't pass this test, you can choose any business structure. It doesn't change the fact that you still have to pay your own marginal tax, individual marginal tax on any PSI income, personal services income. Okay, it is not related to the business structure. It's related how you are receiving your income and this income. Okay, this is very important before you choose a business structure. Okay. Then I put this slide here just to help those people who are considering using a different business structure to put in their investment assets. So it's quite a common question before. Sometimes people ask, I have quite a few rental properties. Can I put them in a different business structure to help me to save tax? Okay, so I just briefly put them here just so that you have a quick overview of their features or different business structures, and then consider what you want to do, okay, in that situation. Okay, so first on individual partnerships. So if you are thinking of putting investment properties there, the advantages, okay, possible tax loss offset. So as we mentioned before, if you're meeting the commercial loss rules, and most of rental properties can, okay, then you can offset a loss with other income. Okay, and then this is quite popular to, if with an individual who purchased a property that's negatively geared, so they actually receive a rental loss. And that rental loss can be used to reduce their other income. So that's possible if you are holding the rental property as an individual or inside a partnership. Okay, also as an individual or a partner, you can have that 50% CGT discount. Okay, so that's the advantages. The disadvantages is very hard to split income. Okay, also there's no asset protection. So let's say if an individual has 4 properties under his name, rental properties, at the same time, he's running a sole trader business. If someone was to sue him, okay, the third party, if they sue the business, they can actually claim their business debts against personal assets. Okay, that's what we mentioned before. So there's no asset protection. Okay, individuals or partnerships. And then it's also very hard to split income, because whatever, if a rental property is earning tax income for you, you have no choice. You have to add it on top of your other income to pay your marginal tax. All right. Okay. Then with the family trust, the advantages are income splitting. So as we mentioned before, with rental income, you can distribute income to different beneficiaries. Okay, so that's one of the main advantages. And then asset protection, you can protect your asset inside the family trust. CGT streaming, you can claim that capital gains discount. Not only that, if you have capital gains inside the family trust, you can choose those beneficiaries first who had a capital loss before to reduce the gain first before you pay tax. Okay, so that's with rental properties. So the issue with family trust is if you are having tax loss from the rental properties, you can't distribute it out. Okay, so basically the tax loss will be trapped inside the family trust. You can't distribute it out. Okay, then excuse me. Okay, the last one with the company, the advantages are the tax rate is flat. Okay, so whatever rental income you receive, you pay that flat tax rate. Also, you have perfect asset protection there. Okay, the disadvantages are again, tax losses can't be distributed. Also, there's no CGT discount for company. Okay. Okay, does anyone have any questions? Sorry about my throat. Nobody have any questions? Okay, in that case, we'll continue. All right, so in the last section, I have included 23 questions here. You can ask yourself. So before you decide which business structure you want to choose, ask these questions to yourself. Okay, make sure. So they will trigger you to consider all the pros and cons I mentioned earlier. Okay, so we'll quickly go through all these questions just so that you understand what's underlying questions behind these questions. Okay, you need to ask yourself. So the first one, you need to understand who are your family members and related entities. And then when you look at different family members, you need to have a look at, okay, what's their income level? Do they earn other income? Of course, by looking at that, you can consider income splitting possibilities. Okay, how much income you want to give them in the future. All right. Okay, second question, what assets are involved? So with the asset, remember, if they have a lot of other assets under their names, you don't want to give them a title or position that's potentially will involve if other people can tap in their personal asset. Okay, so individual trustees of a family trust or directors of a company. Okay, potentially in some circumstances, their personal asset might be tapped in. Okay, then the third question, what are the debts in the family group? So if some people have high debts or an entity have a lot of liabilities, you don't want to connect that entity or that person with another entity or with your new business if there's a lot of underlying assets in your new business. Okay, it's better to set them up separately, okay, because the underlying debt might influence the asset in your new business. Okay, fourth question, okay, determine who will be the principals or participants of the business. Okay, then that's what we talked about before. You know, with companies, it's easier to involve unrelated parties. With family trust, it's very hard. So if initially you want to set up something with someone who's unrelated from your family, then you need to make sure, okay, you want to set up a company instead of a family trust. Okay, and then the fifth question, does family members want to have ownership interest in the entity? So that's a little bit similar to the fourth question. So if they want to have a distinctive ownership, even though they're family members, you might still want to set up a company structure, because remember, with family trust, you don't, or no beneficiaries actually have separate ownership of the underlying asset. Okay, so question 6, is PSI income going to be involved? And we have gone through PSI income earlier. Hopefully you had a good understanding of what's PSI income, because if you do have PSI income, that means that there'll be no income splitting. So it doesn't matter what business structure you choose. Okay, you can't use other people, get other people to share your tax anyway. Okay, number 7, should the entity register for GST? So GST is something, it's a separate issue, and but it should be a part of your considerations as well. So in Australia, if your sales turnover is above 75K, you have to register GST. Or if you're providing a ride sourcing service, such as Uber or taxi service, you have to register GST. No matter, doesn't matter how much you earn. Okay, so that's the GST. Sometimes people want to register GST anyway if their sales turnover is below 75K. That's some different circumstances. Some people might only export to other countries. Then that person might want to claim the GST domestically, you know, for all his purchases inside Australia, then when he export, there's no GST on the sales. Okay, so for those entities, it's actually better to register for GST, even though the total sales is below 75K. Okay, just something brief introduction here. Okay, and then number 8, will the business or investment have significant assets? So this is something you need to consider. Okay, if there are a lot of assets in the new business, then you need to consider more on the asset protection issues we mentioned earlier. Okay, which are the best choices to protect those underlying assets. Okay, number 9, how will the business or investment be financed? Okay, loan or equity. So because before you can answer this question, you need to decide the ownership. Okay, as a company, an equity of a company, that's a distinctive ownership, separate ownership. Loan, there's no ownership. So basically you have to pay back the loan, and then you need to pay potentially an interest. Okay, so there's no ownership related to a loan. Okay, and all the questions here, before you are able to answer this question, you still need to talk to a professional, because with every single question, there are a lot of underlying knowledge or underlying information you need to know, you need to understand. Okay, this is just a brief introduction. Okay. Okay, number 10, what is the risk of exposure to liability of the activity? So this one is more related to the services or goods you're providing. So are there a lot of risks related to the goods or services you are providing from this entity? Let's say, for example, if you are selling food, food products, what if there's food poisoning? Some people sue you for food poisoning. So underlying that, you need to have proper insurance. So that's the first level protection. Of course, after that, you also want to consider what business structures you want to set up to protect you from those risks. Okay, or best protect you if you were sued. Okay, and then just briefly here, there are different types of insurance you can get purchase for yourself. So if you provide goods, there are product liability insurance. Okay, if you provide services, professional indemnity insurance. And then if you get people into your office, there are public liability insurance. So different insurance you can get for yourself to get protected. First, okay, of course, business structure is another way to help you as well. Okay, make sure you know that. Okay, number 11, what will be the expected income level of the business? Normally, if your income is going to be, say, for example, the 20K, say as a sole trader business, your income is going to minimum 10K, 20K. Then maybe it's not a good point to set up a company or family trust structure, because first of all, it's going to be very expensive to set up, and then you're not going to have a lot of advantages on the tax saving because your income is quite low already. All right, so of course you also need to consider the risk. Okay, if you're running a very high risk business, maybe you still want to set up as a company or a family trust. Okay, but if you only look at the income, maybe it's not a good time. All right. Of course, every decision you make, it have to be is a holistic approach. You have to consider quite a few different factors. It's not just one factor only. Okay. Okay. Number 12, will you or your family be drawing money from the activity? Remember we mentioned before. So family trust, you can actually draw money out. And then with a company, it's harder because there are Division 7A rules. Okay, anyone, if you want more details on this, then we can have more conversation on that after the seminar. Okay, number 13, is a business or investment expected to incur losses? Remember, some structures, you can't really use the loss to offset other income. Okay, so with a company with family trust, the loss is trapped in the business structure. All right. And then with the individual or partnership, you can, provided if it's meeting the non-commercial loss rules, you can use a loss to reduce other income to reduce your tax. All right. Okay. So number 14, do any members of family group have future losses to be used? Okay, potential future loss. So that's a bit similar to the last question, I guess. You need to consider what's the possibilities of future loss. Okay, how, whether you can use it to offset against income. All right. So if say with a trust, family trust, after you distribute income to a certain member, if that person have other loss that can be used to offset this income, then that will help. Okay, that's just one example. All right. So number 15, will the principals travel a lot for income producing purposes? So that's one thing we mentioned before on the travel allowance. So company director can be paid a travel allowance, okay, when he's traveling, because he can be treated as an employee of the business. Okay, a sole trader business, a person when he's traveling, of course, he can claim travel expenses, but he can't pay himself as an employee and pay travel allowance or other similar allowance like meal allowance, okay, because there's no employer-employee relationship. All right, that's on the okay, on the allowance. And then number 16, what is the likelihood of bringing additional partners into the venture? So that's the question you need to or you need to consider. Are there going to be other owners involved? So company is easy. So if you're running a company structure, it's easier to sell shares to bring other owners in. With a family trust, it's very hard to involve a non-family member. Okay, because there's no separate ownership. Okay, it's very hard. All right. Then number 17, what is the plan of if a principal leaves voluntarily or dies? So some of the structures is very hard with succession plan. Some of them are easier. Okay, we mentioned before. Number 18, will the principals or other persons be employed as employees? Okay, that's uh, similar before. With different structures, sometimes you can have that employer-employee relationship. With a sole trader business, you can also hire family members as employees. But with family trust, it's actually very flexible. So a family member doesn't have to work for you to earn a salary from you. Okay, so you have other ways to do income splitting. Basically, just distribute them income. Okay, part of the family trust income. They don't have to physically work for you. Okay, then number 19, did you make a business plan? So business plan is quite important just so that you can have an overview of what's going to happen. Okay, what you need to happen during the next years, then it will help you to understand your current situation as well, or what business will be the best to help you. Okay, number 20 is superannuation a priority for the principals. Okay, if you want to pay a lot of super, there are tax advantages as well underneath. And then, so that's one question you can ask for yourself as well. And then number 21, do any restrictions apply to the type of the structure? So sometimes, occasionally to some professions, so say for a solicitor, I think accountants before many years back, that their professional body or the government actually require them, they have to run the business as a partner, as a partnership. So occasionally it's not possible for them to run the structure they want. So before you set up anything, if you belong to a certain profession, do some investigation first, especially if, for solicitors or for any type of profession. Okay, and then number 22, do you have a good understanding of tax structure and tax generally? So that's probably more related to the very complicated structures, you know, with many different layers of different type of businesses linked to each other. If you don't have a good understanding, either you find a very good professional to help you, or try your very best to avoid setting up very complicated structures. Okay, and then number 23, of course, you want to understand, you need to understand what are your top priorities. So what do you really want to get out from this business, and what's the purpose of setting up this business structure? If your main purpose is to protect a vulnerable family member, maybe a family trust will be the best, just an example. All right, so that will be the end of our seminar. So it's the last chance to ask questions. Does anyone have any questions?
Oh, just quickly, with PSI, you can't split income even if it's in a trust. If you decide to
Correct.
have.
Correct. That's true.
Oh.
Yeah, even if inside the trust. Yeah. So let's go back to PSI income, and then maybe I'll give you a couple more examples just so that it's easier for you to understand. Okay. Let's say I'm an accountant, and then I definitely earn PSI income. Then I set up a family trust. But in reality, let's say scenario one, the first scenario, I actually work for a company full-time, 100%. Okay, then the company pay me a salary. Then I actually asked in reality is my employer, but I'm going to quote my client. I'm going to tell my client, okay, can you, instead of paying me a salary, can I send you invoices from my family trust business? Okay, and then you pay me directly to my family trust, even though it's my salary. Then will I pass the test? So let's have a look. So when you look at the test, the first test results test. So for at least 75%, payments made to produce a specific result. So the employer would give me, I have to provide a specific result. Okay, then that's kind of yes. Okay, so we put a tick there. So provide equipment and tools. So when I work for this so-called client, I am actually going to their office. They're giving me a laptop to use. Okay, so that means they are providing equipment to me. So for this test is a cross there, so I can't pass the test. Okay, the mistakes must be rectified at the expense of the service provider. So I'm the service provider as an employee, but when I make mistakes, say I can take my annual leave, then I just leave to take my holiday. Then someone else in the business actually take over. You know, if I did made a mistake, then that means I can't pass this test either. Does that make sense?
Yeah.
So then that means I actually stopped at the result test, so I can't pass the result test. So even though they paid my salary to my family trust, I can set up many beneficiaries underneath, but I can't distribute any dollar to them to reduce my tax. Does that make sense? So basically, when we fill in the tax return form for a family trust, there is a section to ask, did you derive personal services income in the tax year? Then if we were to fill in the tax return form, we have to tick a yes there. Then there's underlying questions. Did you pass the results test? Then we have to put a no there. Once there's a no, then 100% of the PSI income we received to the trust is going to be attached. So it's not going to be paid tax in the family trust. I can't distribute it to other people as well. Then that 100% of that income will be allocated to me as an individual to pay my individual tax. Does that make sense?
So if you don't pass the PSI test, you can't use the company or trust structure.
Correct.
But if you do pass it, you can use the family trust or company.
That's
But
correct. Or you can use income splitting.
and if you do pass it, you can split the income in the trust.
That's correct.
Okay.
Yeah.
Yeah.
So also it doesn't stop there, just so that you know. Let's say if I can't pass a result test, then you flow through. In the actually tax office, on the tax office website, there is a flow chart, those by steps. It's in a PDF format. There's a document there, a flow chart to guide you through how to look at those tests and then see whether you are receiving PSI income or whether you're running a PSI business. Does that make sense?
Okay.
So even if you can't pass the result test, you can still go down 80% rule. So do I receive my income more than 80% from one source? Does that make sense?
Yeah.
Then you
Yeah.
slow down, ask yourself different questions. So only after you finish all the steps, then the final answer is no. Then that means you can't split income using any different structure.
Okay.
Does that make sense?
Yeah, that does. Yeah.
Okay, perfect. Any other questions?
So back a few slides with the corporate trustee, like you showed two different structures. Where does the corporate trustee sit?
Oh, you mean the combination of different structures, right?
Yeah.
Okay, let's say, is this the slide you're referring to?
I think
Like
so, but
yeah,
like corporate trustee might be a different setup or
different side. Oh, okay. So basically, corporate trustee is the manager of a family trust.
Oh.
So remember when we talked about the family trust structure? So the trustee is basically the manager of the underlying asset for a family trust. So for a trustee, there are different forms of trustee. So one form is an individual, like a natural person. You know, like you and I, or I can be Brenda Ferguson. So when we look at the trust deed, the trustee section will be my name, Brenda Ferguson, as an individual. So I'm the individual trustee as the manager of the family trust. Then a different form of the manager or the trustee is a company. So you basically set up a company, so a PTY Ltd, to manage, say, I can set up like a Brenda's company, something like that, PTY Ltd. Then, of course, I have to pay ASIC, the registration fee, $500 roughly. And then I have an ACN number. Then I put that company as the manager of the family trust. Then the main advantage of that is if I don't have any asset inside the company, the corporate trustee, then if people were suing the underlying business inside the family trust, they will first, of course, go to the family trust entity to have a look. Is there any asset there? If there's any asset, okay, they can claim it. Then they go to the trustee level. So sometimes, some occasions, they can actually go to the trustee to claim their liability. Okay, if the corporate trustee, there's no asset in the company, and the company is a separate legal entity, so there's no asset there, they have to stop there. There's nowhere to go to claim their asset. But in a different scenario, let's say the trustee is actually a natural person, as myself, as Brenda Ferguson, then they went to the underlying business in the family trust. Okay, they claim all the assets there. Then they will go to the trustee. In some situations, they will go to the trustee. Then they will trace down to me. Then what do I have? I have my furniture, I have my house. Then they can go to my personal asset. Does that make sense?
Yeah.
Yeah. So that's just another layer of protection when you set up a family trust. That's why normally I always recommend for anyone who wants to set up a family trust, just as an extra layer of protection, set up a company as your corporate trustee. Also, it's actually the underlying, it's actually quite much easier when you want to change your management as well. Because imagine if you put a person there, in the natural person, when you change it, you have to change the trust deed, because that's basically change the document. You know, because trust deed is the governing document, almost like an agreement on how the trust will be run. So that document have to be changed every time you change a natural person. You have to go in and then change what's the trust, who's going to be the trustee. So now if it's Brenda Ferguson, tomorrow it might be a different person. You have to change that document. Okay, so it can be more complicated. With a corporate trustee, you can just change the director. So it doesn't have to be involving the trust deed. You just go to ASIC. It's quite easy for us to do if a client want to change the director of a company. We basically, because we're ASIC agents too, we just go to ASIC agent portal, and then we can change, basically just fill in a form, signed by the client, and change the director. So sometimes if the director at the beginning is like husband, wife, then after they pass away or they are too sick to manage the family business, then they can potentially nominate a child. So just change the director to someone else by changing the real underlying managers. Does that make sense?
Yeah.
Yes, much easier than a natural person. So that's just another icing on the cake that is much easier to change the managers too, on top of asset protection.
I see. Yeah.
Yeah. Okay. Does that make sense?
Yeah, it
Okay,
does.
perfect. Any other questions on any other sections?
Oh, I think that's okay for now.
That's okay for now. Okay, so for anyone who has any questions after either from the seminar or after you watch the recordings, let me know. Our contact details were on the first slide. Okay, if nobody else have any questions, we're going to stop the seminar. And thank you everyone for attending. All right. Thank you.